The majority of a speculator's success is determined before a single trade is ever placed. It is determined by the universe of stocks they choose to engage with, and more importantly, the universe they choose to ignore. Richard Wyckoff taught that the avoidance of unprofitable situations is the cornerstone of a profitable career. The work of a professional is not to find action in every corner of the market, but to apply a series of rigorous, logical filters that systematically eliminate low probability and high risk scenarios. This process leaves only a small, manageable universe of candidates that exhibit the characteristics of genuine professional sponsorship. Today, we will study 5 distinct categories of stocks which he taught to avoid at all costs, in order to protect capital and focus only on opportunities with the highest probability of success. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. The first and most important type of stock to be avoided at all costs is one that is out of harmony with the general market. This is the first and most crucial filter in the entire Wyckoffian process. The primary rule for any aspiring speculator is to first determine the trend of the overall market and then to align all subsequent operations in harmony with that trend. The general market acts like a great ocean tide. It raises and lowers all ships, regardless of their individual quality. To attempt to trade against this powerful, pervasive force is to engage in a futile and statistically losing battle. The first step of any daily or weekly analytical routine, therefore, is to study the price action and volume of the major market averages. During Wyckoff's time, this would have been the Dow Jones averages or similar broad market barometers. These averages represent the collective, amalgamated judgment of the most powerful and well-informed financial interests in the country. Their composite action indicates the direction of the path of least resistance for the majority of individual securities. When these averages are in a confirmed uptrend, the path of least resistance for most stocks is upwards. When they are in a confirmed downtrend, the path of least resistance is downwards. Therefore, a stock that is attempting to rally while the general market is in a confirmed markdown, which is the Wyckoff term for a major downtrend phase, must be viewed with extreme suspicion and should be avoided by the prudent operator. Such a rally is often not a sign of genuine underlying strength. It is far more likely to be a manipulative movement, a pocket of manufactured strength in a sea of weakness. The purpose of such a move is often to attract the attention of the uninformed public, who are desperately searching for the one stock that is bucking the trend. This public buying provides the perfect opportunity for the large, informed operators, whom Wyckoff termed the composite operator, to distribute their remaining shares before the stock inevitably succumbs to the overwhelming pressure of the general market decline. The composite operator is our conceptual model for the large, intelligent interests that plan and execute market campaigns. They understand that a weak market is a hostile environment for advancing prices. Any strength shown against the primary trend is more likely to be a symptom of distribution than a sign of legitimate accumulation. To buy such a stock is to place a bet against the most powerful force in the market. The professional speculator always seeks to have this force at his back, not in his face. The second type of stock to be avoided is what we will term the laggard. These are stocks that are demonstrating weakness relative to their peers, their industry group, or the general market. Capital is a professional's ammunition, and it must be deployed with maximum efficiency. It should be directed only into those vehicles that demonstrate the greatest potential for movement and profit. In the stock market, these vehicles are always the market leaders, never the laggards. After determining that the general market is in a favorable uptrend, the next step in the Wyckoffian filtering process is to identify the strongest industry groups within that trend. Then, within those leading groups, the task is to identify the handful of individual stocks that are outperforming the group itself. This is the practical application of the concept of relative strength. Relative strength in this context is not a mathematical indicator, but a direct visual comparison of price charts, The analyst will plot the chart of an individual stock against the chart of its industry index and the general market average. A stock that is demonstrating true leadership will rise faster and further than the averages during rallies, and it will decline less and hold its value better during corrections. This superior performance is the definitive sign of strong professional sponsorship. Conversely, a laggard is a stock that fails to keep pace. During a market rally, it may advance only sluggishly. During a market correction, it may fall faster and further than the averages. This relative weakness is a critical warning sign. It is the market's own declaration that the stock lacks significant professional sponsorship. The composite operator, with his vast resources, does not waste his time or capital on inferior instruments. He concentrates his immense buying power in the stocks that are most responsive and possess the greatest leadership qualities. A stock that is lagging its peers is, by definition, a stock that is being ignored by, or is likely being distributed by, the smart money. To purchase a laggard is to engage in a speculation based on hope rather than on evidence. The amateur trader often buys a weak stock in a strong group thinking, this one hasn't moved yet. It's due for a catch-up rally. This is fallacious reasoning. It is the equivalent of a gambler at a horse race choosing to bet on the horse that is visibly limping, hoping that it will miraculously recover and win the race. The professional always places his capital on the strongest and fastest horse. To do otherwise is to voluntarily accept a lower probability of success and a less efficient use of one's most valuable assets, time and capital. The laggards of the market must be ruthlessly avoided, as their price action is a clear signal of professional neglect. After we have applied the two foundational high-level filters to our analysis, ensuring that we are operating in harmony with the general market's trend, and that we are focusing only on those stocks demonstrating superior relative strength, we then proceed to the next stage of the selection process. We now move from the broad telescopic view of the market to a close microscopic examination of the individual candidates that have passed our initial tests. It is at this stage that we apply the principles of reading the tape, of judging a stock by its own action, to determine if it is being sponsored by professional interests or if it exhibits clear and dangerous warning signs. There are distinct characteristics on a price chart that should immediately disqualify a stock from any further consideration. The third type of stock that the professional speculator must learn to avoid is the inactive, or dull, stock. This is a security in which the large informed interests, the composite operator, are conspicuously absent. A fundamental law of the market is that a stock cannot make a significant sustained move without the preparatory work and the active sponsorship of the composite operator. It is his vast capital and intelligent maneuvering that fuels the great market campaigns. Therefore, an absence of his activity on the chart is a clear sign that no major move is in preparation and the stock is not a viable candidate for a profitable speculation. The characteristics of an inactive stock are clear and unmistakable to the trained eye. First and foremost is the character of its volume. The daily volume of transactions will be consistently low, often trailing off to a mere fraction of what is typical for the market. This indicates a profound lack of interest from all classes of participants, most importantly, the professionals. This anemic volume is accompanied by extremely narrow daily price spreads. The stock shows no volatility, no life. Day after day, it may open and close at nearly the same price, drifting aimlessly sideways in a tight, lethargic pattern. The overall appearance of the chart is flat and lifeless. It is a visual representation of market apathy. The reason for avoiding such a stock is a matter of pure economic logic. It represents dead money. An amateur trader may be tempted by such a stock, perhaps because its fundamentals appear to be undervalued, or because he believes its lack of movement makes it safe. This is a critical error in judgment. Even if the stock is fundamentally sound, without the active interest and accumulation by the composite operator, it can remain dormant for months or even years. Capital that is tied up in a sleeping stock is capital that cannot be deployed into a vehicle that is being actively prepared for a major advance. It is a profound opportunity cost. A professional speculator's capital is his primary asset, and it must be kept in motion, working in the most efficient manner possible. It is far more profitable to pay a higher price for a stock that is demonstrating clear evidence of professional accumulation than it is to pay a low price for a stock that demonstrates nothing at all. The daily work of the analyst is to find stocks where the composite operator is actively building a cause for a future move. The inactive stock, by its very nature, shows no such cause being built, and therefore must be ruthlessly discarded from consideration. The fourth type of stock to be avoided is one that exhibits a faulty technical position. This is a broad but critical category. It refers to any stock whose own price and volume action is sending clear, unambiguous signals of weakness, manipulation, or exhaustion. The chart itself will almost always warn the astute analyst of impending danger, provided he knows how to read its language. The professional learns to recognize these warnings and to stand aside, leaving the danger for the uninformed and the unwary. There are three primary subcategories of the faulty technical position to avoid. The first of these is a stock that is clearly under distribution. Distribution is the Wyckoff term for the process whereby the composite operator methodically sells his large line of stock to the public at a market top. To purchase a stock that is in the midst of a distribution campaign is the single greatest strategic error a trader can make. It is the act of willingly and enthusiastically taking the shares that the smartest money in the market is desperately trying to get rid of. It is, by definition, to position oneself on the absolute wrong side of the market's most powerful force. The signs of distribution are clear and logical. They include a buying climax, which is the climactic peak of public euphoria, met by an overwhelming wave of professional selling that stops the uptrend. This is often followed by a trading range where the law of effort versus result is in plain sight. Rallies within the range occur on high volume, great effort, but fail to make new highs, poor result, proving that demand is being absorbed by a greater supply. The most egregious warning sign is the upthrust, which is a final, deceptive rally above the old highs that quickly fails and collapses back into the range. A definitive trap for breakout buyers. Any stock that exhibits these characteristics, no matter how positive the news or how bullish the general sentiment, is in a state of technical sickness and must be avoided for purchase at all costs. To buy it is to become the exit liquidity for the professional who is selling. The second subcategory is the stock with erratic and manipulative action. Professional campaigns, whether of accumulation or distribution, are generally conducted in an orderly and logical fashion. The price action, while sometimes volatile, has a discernible structure and purpose. An erratic stock, by contrast, is one whose price movements are chaotic, illogical, and difficult to analyze. It may be characterized by days of extreme, wide-spreading price bars that appear on little to no volume, followed by days of high volume that produce no price movement at all. The price may jump and fall violently without any of the preparatory cause building that is the hallmark of a professional campaign. This type of action is often a sign of a thinly traded market, one where there is no dominant composite operator providing stability and control. In such markets, the price can be easily and recklessly manipulated by small pools of operators or by emotional, disorganized public trading. A scientific analysis based on the principles of supply and demand becomes impossible in such an environment. It is a game without discernible rules, and the professional speculator knows that such games are not worth playing. He avoids them entirely in favor of the more orderly and readable markets where the footprints of the composite operator can be logically traced. The third subcategory is the stock that has just completed a climactic or parabolic advance. An uptrend that concludes with a near-vertical explosive rise in price is a sign not of ultimate strength, but of ultimate exhaustion. This parabolic action is the visual representation of the final frantic stage of public buying. a speculative frenzy driven by pure greed and the fear of missing out. Such moves are, by their very nature, unsustainable. They almost invariably end in an exhaustive buying climax, which marks the point where the last of the public buyers have been drawn into the market, and the demand is completely spent. To purchase a stock at the conclusion of such a move is to buy at the single worst possible moment. It is to enter a position at the point of maximum price extension and maximum risk, just as the professional interests who engineered the move are completing their final sales. After a climactic run-up, a stock requires a long and often difficult period of correction or distribution to repair the technical damage. It must be avoided until it has undergone a new, lengthy period of accumulation and has once again proven itself worthy of a professional's capital. Wyckoff's method of stock selection is a masterclass in reading the internal action of the chart to determine a stock's true health. But other market titans had different, equally valid filters for what to avoid. Bernard Baruch, for instance, would avoid any stock, no matter how good the chart, if the broad fundamental economic conditions were unfavorable. Nicholas Darvas developed a unique system and would automatically avoid any stock that fell out of its current box or price range. Richard Dennis had strict liquidity rules and would avoid markets that were too thin or too volatile for his system. To explore these diverse selection and avoidance criteria, we created our new channel, Trading Insights. It is a library of market genius dedicated to the methods of the world's greatest speculators. If you want to build a comprehensive set of professional filters, we invite you to subscribe and watch. The link is in the description. We have now established the first 4 critical filters that the professional speculator applies to his daily work. We have learned to avoid stocks that are out of harmony with the general market, to discard the laggards in favor of the leaders, to ignore the inactive stocks that show no sign of professional sponsorship, and to reject any candidate that exhibits a faulty or dangerous technical position. We now arrive at the 5th and final filter. This one is not primarily technical, it is psychological. It is arguably the most important rule of all, as it serves as the ultimate defense against the most common and costly errors in the entire field of speculation. The 5th type of stock that Richard Wyckoff taught to avoid at all costs is the tipped or story stock. This is any security whose primary appeal is based not on the clear and unambiguous evidence of its own price and volume action, but on a narrative, a rumor, a tip, or an exciting story that comes from a source outside of the market itself. The professional speculator is a scientist of the tape. His core, guiding mantra, the principle from which all of his success derives, is to judge the market by its own action. Any information that attempts to persuade him to ignore the verdict of the tape is not merely useless, it is actively dangerous. In his extensive writings, Richard Wyckoff was profoundly and relentlessly critical of the role that tips, rumors, and unsubstantiated stories play in the financial ruin of the public. A whispered tip from a broker about a pending merger, a sensational article in a newspaper about a revolutionary new invention, or a rumor in a boardroom about a massive government contract. All of this, to the trained Wyckoffian analyst, is nothing more than noise. It is information designed to appeal to the emotions of hope and greed, and to short-circuit the process of logical, evidence-based analysis. The amateur trader, hearing such a story, becomes excited. He feels he has been given access to privileged information, a secret key to a quick fortune. He abandons his chart analysis and buys the stock based on the story alone, convinced he is acting on superior knowledge. The professional avoids this trap by adhering to a simple, inviolable piece of logic. He reasons that if a story is true, if a company has indeed made a revolutionary discovery or is about to be acquired at a premium, then that information will inevitably be known to the most astute and well-informed interests in the market. It will be known to the insiders, the directors, and the large financial operators that constitute the composite operator. And if the composite operator knows this information and believes it to be credible, he will act upon it. He will begin a campaign of accumulation, quietly buying up the shares of the company in anticipation of the future good news. His actions, his large-scale buying, cannot be hidden from the tape. The evidence of his campaign will appear on the chart in the form of a selling climax, the process of absorption, a shakeout, and an eventual sign of strength, all confirmed by the corresponding volume signatures. Therefore, the professional speculator's response to a tip is not to rush out and buy the stock, but to calmly turn to his charts and look for the evidence. If the exciting story is confirmed by the price and volume action, showing clear signs that a professional campaign of accumulation is or has been underway, then the story has merit. But if the stock's chart shows no such evidence, if the volume is low and apathetic, or if the price action shows signs of distribution rather than accumulation, then the professional knows with a high degree of certainty that the story is a fraud. It is not a genuine tip, but a piece of manipulative publicity, deliberately disseminated for the sole purpose of creating a market of willing buyers into which the insiders can unload their own shares. The tape does not lie. The composite operator's actions do not lie. Stories and rumors very often do. The professional trusts the evidence of what the smart money is doing, not the noise of what the public is saying. These 5 rules of avoidance are not merely a loose collection of helpful suggestions. They constitute a systematic, sequential filtering process that the professional applies to his work every single day. They form a logical checklist that must be completed before any stock is even considered a viable candidate for purchase. This process is designed to be ruthless in its application. Its primary function is to say no, to eliminate the vast universe of unsuitable and dangerous opportunities in order to isolate the rare few that meet the stringent standards of a professional campaign. Before giving any stock serious consideration, the prudent analyst must therefore ask himself these 5 questions in this specific order. First, is this stock moving in harmony with the general market? If the market is in a confirmed downtrend, the inquiry for a long position stops here. Second, is this stock a leader in its group? If the stock is demonstrably weaker than its peers and the market average, it is discarded. We are only interested in the strongest performers. Third, is there clear evidence of professional sponsorship on the chart? If the stock's chart is lifeless, with low volume and narrow spreads, indicating the absence of the composite operator, it is discarded as dead money. Fourth, is the stock's immediate technical position strong? If the chart shows clear evidence that the stock is currently under distribution, characterized by signs such as a buying climax or an upthrust, it is immediately rejected as a candidate for purchase. And fifth, is my interest in this stock based on the clear, evidence-based signals on the chart, or is it being influenced by an external story, tip, or rumor? If the idea did not originate from an impartial analysis of the market's own action, it is suspect and must be discarded. The answer no to any single one of these questions should be sufficient cause to immediately and permanently reject the stock as a potential purchase. This disciplined exclusionary process is what protects a professional's capital. It ensures that he only ever focuses his time, energy, and money on the small handful of opportunities that have passed every test and have demonstrated the highest probability of success. We have just covered 5 critical rules of avoidance. This disciplined process of selection and rejection is what forges a professional mindset. Richard Wyckoff illustrated the importance of these very rules through his own successes and failures, which he documented in his foundational work, How I Trade and Invest in Stocks and Bonds. In this book, he shares personal stories, such as his experiences with treacherous mining stocks, which are often classic story stocks, and lays out the fundamental principles he used to judge a company's character and market position. This book is not just theory, it is the practical application of these avoidance rules in a real-world career. It provides the essential wisdom behind the rules. The link is in the description. In our final conclusion, we have established 5 distinct and logical categories of stocks that the professional speculator, following the methods of Richard Wyckoff, must learn to avoid at all costs. These are stocks that are out of harmony with the general market, the laggards that are weaker than their peers, the inactive stocks that lack professional sponsorship, stocks that exhibit a faulty or bearish technical position, and finally, the tipped or story stocks whose appeal is based on narrative rather than on evidence. The great secret to long-term success in speculation is the realization that it is, to a very large degree, a defensive game. Your ultimate profitability will be determined not so much by the brilliance of your occasional winning trades, but by the number of foolish, low probability, and unnecessary losses that you are able to systematically avoid. The consistent daily application of these 5 professional filters will dramatically elevate the quality of your speculative endeavors. It will protect your capital from the most common and dangerous traps that the market sets for the unwary. And most importantly, it will force you to abandon the impulsive habits of the amateur and to begin, finally, to think and to act like a true professional of the tape.